This is Street Signals, a weekly conversation about markets and macro brought to you by State Street Markets. I'm your host, Tim Graff, head of macro strategy for Europe. Each week, we talk about the latest insights from our award-winning research, as well as the current thinking from our strategists, traders, business leaders, clients, and other experts from financial markets. If you listen to us and like what you're hearing, please subscribe, leave us a good review, get in touch. It all helps us to improve what we offer. With that, here's what's on our minds this week. Events in the Middle East remain fluid, but it does seem as though the market sensitivity to headline risk is fading, or at least the pricing for worst-case outcomes is increasingly being downplayed. Whether or not that remains the case, we have no ability to say with any degree of confidence, but equity markets are back at all-time highs, led, as they so often have been in recent years, by gains in tech shares. Many of the same questions we had about concentration risk in tech, their valuations, any emerging credit concerns, and how to position across asset markets are as valid now as they were prior to the conflict starting. So this week, we catch up with Dan Gerard, a senior strategist on our team in Boston, who's just written a piece on U.S. equities which addresses many of those questions and the outlook for U.S. stocks over the medium term. One caveat. Bear in mind this was recorded last Friday afternoon in the midst of a very strong rally in all things risky. Things might well change by the time you listen to this, but I think the questions and Dan's answers will hold up, no matter the market regime.
Hello, Tim.
How's it going? Happy Friday. Quite the day to record this on.
I know. I mean, we could tell it's coming, right? Like the market has just been looking for any absolute optimistic chunks and nuggets to hold on to.
Yep. This is a good nugget. Dan, it is a very timely time to have you back on. It's great to catch up with you as always. You've just published a piece, actually, that couldn't have been more timely, titled U.S. Equities, Worse Behind Us or Pain Ahead? And I'll probably talk about this in the intro, but we are in the midst on a Friday afternoon of a 10% drop in oil, a massive rally in equities, and all things risky. So I guess let's just get to it. The title question, is the worst behind us, or are we setting ourselves up for more pain?
Yes. Well, look, it took me a little while to put that piece out. Every day, I was trying to find the perfect time, and we would have these big swings. But eventually, you have to just get it out. And of course, the various components of the market, the various asset classes, are all interrelated, and it's easy to talk in circular logic. But in this case, the circular logic may be justified, and keeping the let's say the same shape of metaphor here, it's more of a feedback loop, right? It's let's take the equity market to start. I think in the short term, look, we know the market is trading on war news, and for good reason. This market has been one that has been looking for any signs of positivity, any signs that this obstacle of supply chain, of energy, of input costs is beyond us. But once we move past this, and it's looking like we will today, numerous obstacles remain, I think. And let's try to put that in context. I think prior to the financial crisis, we used to have much clearer cycles. There was liquidity-driven cycles and earnings-driven cycles, and pauses and corrections in between, depending on where we were in this rate credit cycle itself. That really drove opportunities and risks. So what changed after the GFC? Well, I think it was direct Fed intervention in the markets. And when the Fed started to use its own balance sheet, Japan style, to provide liquidity where private participants couldn't or wouldn't, it opened up a can of worms which we've never really been able to close. So are we in a liquidity-driven phase, or are we in an earnings-driven cycle right now? And the answer is yes. Plenty of liquidity that's been available has inflated valuations across the board. And some of those companies that could fund themselves cheaply with revenue and more specifically free cash flow, could reinvest and drive earnings. And the evidence is right in front of us. There are companies, industries, sectors that have performed really well, mostly due to asset inflation. And there are those who have benefited from that asset inflation that have also been driven by earnings. So the answer to the question, is the worst behind us or is there more pain to come? The answer is also yes. If we stay on this path, the environment we're heading into is a much more liquidity constrained environment, which will make earnings even more important. So, where are the earnings? Well, they're still in US large cap growth, tech exposed companies, a few others, and I think some of that healthcare and areas that are traditionally defensive and sometimes value, sometimes growth are also in there. But that's where we want to be. We want to be where the earnings are heading into this at least pseudo no new phase of the cycle, and that still justifies concentration. It doesn't vilify it. And I think that that's the most important part of this here.
And just to be clear, when you talk about liquidity and liquidity constraints, is that kind of credit provision in another word?
Credit provision. I
Yes.
think it is.
Okay.
I mean, look, it's a balance sheet term, of course, but I think it's nice to look at markets from a balance sheet perspective, right? It's are we seeing deterioration or improvement in balance sheets, and how does that impact behavior from both companies and consumers?
All right. And so sticking with this current episode, and you've written a piece about it. I published a piece today about the volatility aspects of this particular episode and how muted they were. I mean, we can only look at Liberation Day as a parallel for the second Trump administration in terms of
Right.
administration creating a volatility shock, and this paled in comparison to that. But we have other examples of volatility shocks or just market adjustments in relation to geopolitics. We, of course, have a pandemic to point to, that this was, again, far more constrained an event then. Why do you think both the price response and the investor response has become less sensitive to this particular geopolitical shock? Is there a generalization there that you think you can make about just the overall sensitivity to geopolitics on the part of equity investors specifically?
I think, Tim, you're dead on trying to bring some of those parallels of other periods. And uh, I think that's the way to look at this. I think, 2025 and 2026, they've really been driven by some similar themes and some very different themes. But there was a lot of hand wringing last year about the tariffs. This was like an issue that was really complicated further by the massive political divide as well. We we can get into that or not, but the tariffs were seen by many as kind of an anathema to the system that's worked so well. It was an added tax on consumption. It complicated the free market ethos of specialization. It potentially upended the system that has worked for so long, which is one where the US's largest export was US dollars and US debt. And many felt that this would be a massive hindrance to the US's position as the best of the best market. And many, and driven as much, I think, politically as by markets, believed the US run was over. Of course, this didn't turn out to be true. There were so many problems with that thesis. To name two massive issues, which we pointed out last year: one, the tariffs aren't a value added tax, not the same way that value added taxes are, right? They're not an obligation. The system is easily gamed by those who have the resource to game it. Two, the amount was really never going to add up to very much in relative terms. So I think there's more, but just sticking with those two, those who allocated away from the US were not rewarded to the degree they thought they would be. And that set up 2026. Many, having learned their lessons from 2025, weren't really going to be pulled away again. They continue to learn that Trump can go from calling for the annihilation of a civilization to paying dollars for peace in a matter of days. And perhaps only with very minor cynicism, I can say that politicians are also invested in markets going higher more than they are in activism. And I think that that really does play into this as well. Investors and just market participants in general have come to that feeling, or I don't know if it's a realization, but that's their motivation, that they they believe the system is with them. And I think that that plays a lot now into the lower volatility, which you pointed out in the piece.
Can you kind of typify what the credit provision environment then looks like? I mean, we Q1, before all of this began, we there were the worries over private credit and that feeding back into public credit potentially. But if you were to look at credit spreads, and I have a chart of them that is persistently on my desktop, you would not know that one of the more worrisome geopolitical scenarios we've all thought about the last 30, 40 years has played out because credit spreads did not move, or public credit spreads at least did not move. So Can you talk about the state of credit fundamentals and particularly commercial bank credit provision and where we might sit in this cycle, particularly vis-a-vis Fed policy, which we are going to talk a lot more about later, but with respect to that?
Yeah, with the danger of going into a deeper rabbit hole with a question like this, let's try to keep it where we see some real, I don't know, evidence or what we're seeing from two sides of it. We it used to be, let's start pre GFC, pre financial crisis, that credit provision was really a choice of commercial banks. It was a choice of, on the asset side of their balance sheet, are they creating loans, which is credit provision in the real economy, which drives earnings? Or if there's no loan demand, and usually because there's no loan demand, it means that rates are sufficiently high enough to impede loan demand, that there is an opportunity in fixed income and securities markets for them, and they invest in mostly the treasury market and agency market. So that meant that we had this natural cycle that if rates were too high, then banks could invest in the rates markets, bringing rates lower. That would then bring up earnings, a real economy loan demand again. And once we got past the financial crisis with the Fed's much more direct intervention of buying bonds, most of the policy we've seen has pushed credit from banks into the securities market and really not into the loan market as much, to a greater degree, or where it should be in an environment like this. So somebody stepped in, private credit stepped in. Other credit providers have really disintermediated banks in that area. That makes it much harder because this is outside of the Fed's direct supervision, much harder for them to even see what's going on. We don't even have the data aggregate to see what's happening. So we do know that banks continue to buy treasuries to a pretty strong degree. They're taking a bet that we are at peak rates. And that money, let's say it's cycled through financial markets. It continues, that new money, banks are creating new money, keeps valuations high. It keeps credit spreads tight. It's really two sides of the same coin. And unless we see a real rise in that kind of belly to longer end rates, they're winning on that side. So I think that that's why we continue to see this credit provision in place. And the private credit side, yes, there are worries, but the worries are not insolvency. The worries are liquidity. And until that illiquidity is turned into something else, then it's still okay. And I'm not saying it won't, but when you have a notable bank, the employees chip in money to actually bail out the redemptions in a fund, that tells you that liquidity is still pretty strong in that field. We're not at danger of breaking yet. It's just, again, one thing we cannot lose from our watch list. And I think the symptoms are valuations in credit spreads, not the drivers.
Right. Right. Got it. Well, you're quite right. We don't want to go down a credit rabbit hole, not least because this is ostensibly a podcast about equity markets. So let's focus on that part of the balance sheet a little bit more. And I wonder if we could start with just going through our indicators of behavior. And, again, we've talked this podcast, the last couple episodes, about this being a low volatility affair with light de-risking, if there was de-risking really at all. How did institutional investors play through this latest kind of upheaval in markets? What was the behavioral response?
The behavioral response is, I think we need to put it into two different periods for this latest stretch. We had Q4 really solidified this concentration theme that it was about the US and it was about tech and everything was looking good, and started to wobble a little bit at the end of Q4. And then we got into 2026, into the first couple of months, and there was this feeling that keeps creeping in that investors don't want to be caught with their pants down on the concentration trade. They've been saying for so long, the concentration is a worry. And if it does go the wrong way, then they are very exposed and they don't want to be. So they keep looking for something, this hope of a broadening economic theme. That's what January and February were all about. It was about investors starting to say, we have so much US, so much tech, so much equities in general and growth. What else can we look for? So they started to look for the traditional economic cycle type stuff, the more of the industrials, materials, and energy, even before this started. What I mean, before the conflict started. And that broadening view was not based on earnings. It was not based on an improving earnings metric. All of this was the hope that the conditions we saw, a Fed with a bias to ease, better growth expectations, pretty cheap costs overall, pretty reasonable energy costs, if not historically very cheap, were all going to help the global growth story. And that's where they went. As soon as we hit the end of February and the invasion started in March, that put investors on notice again. And they kept their very high equity allocations. But this allocation change was really about energy back to quality earnings again, some healthcare again, and away from that European story, the value story, the traditional growth story. And every time actually that we saw these nuggets of news that the war was, had run its course, it wasn't that they went back into to traditional growth. They went back into the tech story again. And I think that really underscores the importance of earnings here. In order to get back to the January, February story, this Q1 story that keeps popping up perennially, that we need to see better signs of earnings that are durable in those spaces. And we're just not seeing it yet. And we would need to be at a very different place for that to happen. So I think that that's important. The other side of it is, in our data, we have not seen demand for duration for various reasons for a long time. And there still is this fear of maybe disinflation ending, of a higher term premium, of risks in that space, and opportunity in the short end of the curve. So that's where investors are. They're allocated in their risk bucket to equities and to private credit and to worse rated credits, and they're allocated to the short end of the curve in the safer sense, because they can still get a pretty good yield in that spot and hedge their risk.
Well, I wanted to talk about tech as part of it because if I look, and here's some numbers over the last week, this is as of Friday afternoon. So basically this calendar week, tech is up 8%. Discretionary is up 7%, communication services, so the other part of the tech trade up 5%, energy off 5%. So the rotation has kind of reversed itself. But now, of course, equities at all-time highs. We were close to them the last episode. We are now through them, and maybe we'll stay that way through next week. Who knows before this goes out? But we now then bring back some of those fears you mentioned at the very beginning of the year or at the end of last year, concentration risk and valuation and earnings we definitely want to touch on. But concentration risk is a factor. Do we actually have to start thinking about this as a worry again? Why or why not? Is that a factor?
I think about this a lot, and I try to look historically at some of these periods of concentration risks, and what I've found is I think it's underappreciated how rare it is that the concentration risk comes in the highest quality part of the market. Usually, you get concentration risk because there's either new innovation, new industry, something that is getting people's attention that doesn't have earnings yet, that doesn't have cash flow yet, that is expected to. And even if we look back at big industrial changes like the railroads, which without a doubt changed the way the world operated and grew, it was all funded by debt and massive amounts of debt. And once you overbuilt, that was a story in free fall. So in the tech concentration space, what we have is industry funded or innovation funded by free cash flow. Yes, they're taking on more debt, but they're taking on more debt because providers of credit are offering them tremendous terms, and why not? They don't need it. Some of the more AI play and newer players is different, but for the ones that matter for our index, this concentration is for a reason. It is, I put the parallel of like the semiconductors trade more on terms of that model is more like illicit drugs, right? I mean, that's the model. You take $35,000 of silicon, you put it through your already made fab, you stamp it, and it's worth $30 million, right? That kind of a margin is tremendous, and the demand is only growing. What are the worries out there? The worries are we're not opening the market to China fast enough. There's too much security worry in the business model. But a lot of these companies, they don't need more markets. These chips are sold, for quarters and quarters and quarters ahead. We're not at that point yet. This concentration is for a reason. I think we're still in the early to middle innings of that trade, and that's because these companies are going to enable the rest of the non-tech world to become more efficient, to have better margins. But it's going to create a big upheaval in things like labor that we're not really prepared for yet. That's probably another topic for another podcast of yours. But that's really where we are. So I'm not worried about concentration yet. I think this is still much more of, if you want to make parallels, a market like Google in 2007, where people thought, is this a value stock or is it incredibly overvalued? And it turned out to be a value stock. Than it is, 2000 internet stocks that had really no basis to be trading where they were based on earnings potential in an unknown market. So I'm still not worried.
Yeah, and I wanted to kind of come at this from the other side of it and look at it the other way, which is on earnings, because of course a lot of the rally we're seeing is being propelled by stellar Q1 results now, and I'm curious why, given all of the things you've said, the demand quarters ahead that is, the producers cannot keep up with, that supply demand imbalance is a known known. And so I'm just curious why you think markets and investors continually underestimate earnings, not just for tech, but for the market overall. Why does that persist?
Yeah, I wish I knew, Tim. I think that there's a couple of things here which I find, just to your point before I answer, it's not just the market and investors. These companies are the most watched companies with the best technology to watch these companies we've ever seen in history. These companies are literally the most channel checked companies we've ever seen in the history of the world. And analysts who are paid to estimate their earnings still underestimate their earnings. And that is just remarkable. So what do I think that the world continues to underestimate the power here? I think it's just the fear we've never seen this before, and we're not prepared. Anyone alive today in these markets was not around during the railroad boom, and most of them were not around during and I think all of them were not around during the airline boom as well. So the history from what we have seen from some of these internet giants in the past 20 years should tell us that these things can last a long time. So I think it's really about fear of being caught off sides, not just the fear of losing money, the fear of losing your job because of your concentration risk. And that keeps people in check and looking for something else.
I've been trying to think about how I want to segue this to policy, and I think we've just opened the door insofar as this technology, of course, is disinflationary potentially. It certainly is designed to make us more productive, or that's the hope, at least, if it doesn't destroy us first. But I'm trying to think about, well, I think everybody is trying to think about, and I want to get your thoughts on the potential disinflationary impact of technology vis-a-vis the inflationary impacts of now potentially higher and equilibrium energy prices. Who knows? Maybe we will completely unwind this spike in oil. We're already doing a pretty good job of it today. But nevertheless, it is likely to be a short-term inflationary impulse. You still do have relatively tight-ish labor markets in Europe, less so in the US, but they're not weak labor markets. But then you also have other disinflationary forces like shelter. You have the base effects from the tariffs last year. Where do you fall out on inflation, its persistence above target, whether those kind of, let's call them transitory factors are indeed transitory, and whether technology will contribute to returning inflation to target, or is it something that's more persistent in your view?
Yeah, there's a lot there, and I'll try to keep it on point here because
Sorry, I do appreciate I ask huge, long-winded questions.
No, but I mean, there's just like we could talk about that topic for hours. but I think that the way I think about this, and your question just made me, the way you phrased it, made me think about a discussion I had with Roberto Rigobon in probably pre-pandemic, probably 2018 or 2019, about why there was no inflation, why we didn't see it at all, given all of the inputs in credit provision. And my take was because tech is always disinflationary, if not outright deflationary, and everything was becoming tech. Everything. That's the trend we saw in that period. But what's different about then than now? I mean, we even with the rising cost of oil, it's not inflation adjusted that high. It's not like previous crisis levels. The potential is there, but it's not. So I think there's a couple of things that I really try to I use to try to help explain some of this. I think that the problem is one, the Fed, I think, has abandoned getting back to target. I think people think that, whether it's true or not. The more time you spend above target, I would argue the harder it is to return without an external crisis. And we have seen when yields get stressed that the market, they need a hero in a Bonnie Tyler sense. Central banks flood the market preemptively to protect the markets. And I might be a dying breed, but I still believe, unlike Chairman Powell, that we are seeing the effects of credit driven liquidity and the lack of supply of things like shelter continue to put pressure on prices. And the evidence, I think, is on my side. Given like disinflation to any serious degree has ended, that once the Fed moved to a cutting bias, that the expectations are there for higher inflation. And that's the difference between pre-pandemic and now. It's the time above target and the expectations that have been built into consumers. I'm pretty sympathetic to this academic thesis that says that the longer you stay above target, it kind of at a higher than normal average, it conditions a consumer to expect higher prices, and media driven events like the one we just had, that provides cover to pass through hikes that help margins. We never saw that in the 30 years prior to the pandemic. Consumers outright rejected price hikes. China, of course, their supply also played a huge part in that. And that phase is arguably in the rearview mirror. But when we look at the other components, I think the housing market is actually showing signs of renewal, not danger. Anytime rates come down even a bit, we see demand spike again. Commercial leases are being renegotiated and commercial rents are coming in higher. That's where services inflation comes from. The rent of a barbershop, not the cost of the scissors, is what makes services prices higher. And all of those factors are in there. So, yes, tech is disinflationary. It always has been. It hasn't really changed. But I'm still not relying on an AI haircut. Um, you might be.
It's a lot easier for me. Thanks for that, Dan.
But yeah, I think that's the difference. It's expectational, and we keep letting that slip away from us the longer we stay in this condition.
So, as a result of that, I mean, you can also point out, not that it's the Fed's job to manage financial conditions, but this week we had the anecdotal evidence of a shoe company pivoting to AI and being rewarded by the market to the tune of like a 300% return in on the day. We talked a lot about the kind of healthy conditions of investing, the passive flows coming in that acknowledge that they can't, the people who can't beat the market will just at least passively allocate to it. But then you have these sort of euphoria type of scenarios where the relief, I think, of what we've gone through this week transmits itself in that way. But it also speaks to an investing environment where the Fed is, kind of not going to get involved necessarily. They're not going to burst that bubble. It's not their job, and nor should they. But it does speak to that conditions may be easier than one might otherwise believe. Would you say that's the case? And does it ring true to you that of the G10 central banks, the Fed is priced to be kind of the least hawkish after this episode?
Yes, it does ring true, and I think that is asymmetrical as well. Yeah, it's not the Fed's job to kind of maybe burst the bubbles in sense, but they have put a floor on markets above everything else. And that's really what we've seen. And I think markets have come to expect that as well. as soon as there's any trouble, they'll open a facility. And that facility it's called this is not quantitative easing facility. It's just here temporarily. But that's what markets have come to expect. And I think that matters a lot. To the point about the shoe store or the shoe manufacturer, we're going to see a lot more of this. And we can be cynical and say that it's part of a trend to take advantage of a theme to get investors. And part of that is we see that every single time there's a new theme in the market. However, the power of AI is going to be its transformation of everything else because AI is doing the CapEx that everyone else does not want to do. And now we have someone who can do it efficiently and well. And there are very, very few people who can do that. So I think that is the next stage of the market. And that's not for a while. How we quantify a while, I don't know. But at some point, we're going to see that transformation of industry, traditional industry, all adopting this trend and helping their margins and helping growth. And it'll just leave us with one question, and that is, well, two questions. Where are the workers going, and what do we teach our kids in school? I mean, those are pretty powerful questions to answer, which I will again let you deal with on another.
Yeah, no, that's not this podcast, I don't think. Call her daddy, maybe. Not this one, Joe Rogan.
Yeah.
I didn't want to completely overlook the energy side of this because that was, I mentioned the rotation into energy, or you talked about it. And then I brought up over the last week, the price action, the rotation away from energy. And, again, we're going to probably see that today with oil prices now off 12% as we record this. What is your thinking on where equilibrium energy prices are and the investor response? Is this just going to be a very short-lived rotation that has now no real valuation or earnings justification to back its persistence?
Yes. Well, I think on the energy side, I think in the near term that there's still opportunity here. We're getting the gyrations of massive threat of supply balanced with some of this supply can come back on again. However, I don't think that the energy trade is that durable over the long term. The higher the energy prices remain, the more impetus there is for investing in something else and getting quicker to a solution that's more sustainable. For so long, for a variety of reasons, we have underinvested in the United States in what we really needed, which was nuclear power. And nuclear power at this point in time is really the only solution to solve many of the energy prices. And we're trying to catch up. It's going to take another decade, but that decade will mean there is a lot of volatility in the traditional fossil fuel market. And that will be, if you think you can time that well and you understand the dynamics of production and how quickly it can come on and get shut off, then there's opportunity. I certainly don't have it. What I do know is that if we want to progress in the world that technology is setting us up to progress, we are going to need a replacement in massive, massive form very soon. And I think from everything I see in investment banking world and the funding of new deals and new companies and new ideas, that nuclear is really it's got momentum, and regulators are coming back on board as well. And there's just less antagonistic environment than there was now than there was in the 70s and 80s for lots of reasons.
There's a more micro idea. Let's start to wrap things up and get your big picture thoughts. I mean, I'll kind of reiterate the opening question, but ask it in a different way. If you had to think about how you're invested we've got about 8 months left this year, so let's do that. Kind of end of the year time horizon in your big picture asset allocation decision. It's, based on the discussion, it's not clear to me how you'll answer this in terms of equities versus bonds, but especially given some of the things you've talked about with respect to the Fed's reaction function to this. So go for it. What is your asset allocation preference here on out? And then let's drill down into sector level and whether tech continues to dominate that portion of the equity allocation.
I think what's most clear to me is that the fear of credit of duration risk is the most dominant. So I would say I would be overweight equities and overweight cash, or let's call it short duration, and one hedging the other. And that makes a lot of sense for the foreseeable future, especially given that the concentration in a lot of equity markets, or the ability to take this concentration risk, is really all you need when thinking about emerging markets and developed markets. You can pick your countries pretty well based on what your outlook is on growth versus value, et cetera. So that's what I think is the most important part here. Don't give up on equities yet, because really what's going to cause the equity market to stumble is the underperformance of duration. It's going to be higher rates, and that is all going to be much more connected than it has been previously. Create Because it will unwind the liquidity factor that's been driving equity valuations so well. And in that environment, you want earnings growth, and you want to really pick where the earnings growth is.
Is the US still best poised for that? I mean, the early part of the year, late last year, it was very much an EM story, Korea, Taiwan, same block of companies or types of companies, but their multiples potentially being the more attractive way to express it. Which of those two ways of taking that tech concentration risk do you prefer?
Yeah, I think a lot of this, our positioning data helps a lot with this. And, obviously the US continues to be a very overweight position, and there's less positioning risk in the emerging markets, and that remains. Valuations have, of course, come down a bit, and these tech companies continue to grow into their multiples, unlike everything else. So I think that you need both. You need to stay invested in the US markets because of just the weight. It's incredibly hard to make up US underweighting with EM Asia overweight. It's just you'd have to
Fair.
take massive risk.
Yeah.
But you need both. And I think that that's where the performance is going to continue to be.
Is there a part of the market that is unloved that we haven't talked about that you actually do really like?
Yeah, but I've liked it for years, and that is healthcare, especially in that pharma space.
Yeah.
Look, I think that it is just it's puzzling to me why you have a market, or a sector that has really great margins, great earnings growth, is acyclical in the sense that it's not as sensitive to the rate story, and continues to have pretty good earnings in a demographic that supports it, that has not been doing so well and has been kept to an underweight position. We are, in our data, are starting to see that change, and I think that that's an important flip in the mental state of the investor. That it will be quite important that those earnings will start to be appreciated a bit more. I know that there are always concerns about the quality of earnings, when you make adjustments to earnings based on what supposedly are non-recurring factors that just keep recurring time and time again. But yes, I think that we have finally started to see the flip in mindset on the better quality areas of healthcare.
Final question. What is, after all that we've talked about, and it's been as in depth as we kind of were thinking it might be a discussion, what's the one thing that you're looking for that might change your priors, change the views that you just put out and really cause you to flip around?
I don't know if it would cause me to flip. I would say the thing that is most top of mind for me, what I'm spending a lot of time worrying about, is the treasury supply versus demand story. And I think that this is, we kind of take for granted that the US issues debt, we borrow everything we don't get from taxes, and it continues to rise, and everything still is fine. But you need buyers. We're issuing debt at crisis levels with no crisis. And that is just remarkable. Where the 30% rise over the past couple of years in debt issuance, it needs a buyer, and we're finding it harder and harder, especially in the long end of the curve, to find it. So when we look at who the natural investors are here, it's really just a small group of people. It's sovereigns. Sovereigns are certainly not raising their allocations to US Treasuries. It's institutional investors, and we see both foreign and domestic institutional investors outright selling now of their treasury debt. It's sometimes the Fed, depending on their mood. And the other is commercial banks. And commercial banks have been big buyers. If rates rise, if we start to see that term premium or whatever inflation expectations create a rising long end, then that puts real pressure on commercial banks' assets. And that's where deleveraging starts. And that would actually change my mindset quite a bit. So I'm worried about who's buying the treasury debt, given war will now mean more borrowing, which we've already seen.
Well, you mentioned the Fed. They, of course, can step in, but that
Now, of course.
introduces, that introduces like a fourth or fifth podcast idea that has come out of this discussion, and I don't want to put that burden on you as well. So I will just leave it there and say thank you. As always, Dan, it's been great to chat. It's always great to get your thoughts. Really appreciate you taking the time.
Thanks so much, Tim. Really appreciate it.
Thanks for listening to Street Signals. Clients can find this podcast and all of our research at our web portal, Insights. There, you'll be able to find all of our latest thinking on markets, where we leverage our deep experience in research on investor behavior, inflation, media sentiment, and risk, all of which goes into building an award-winning strategy product. And again, if you like what you've heard, please subscribe wherever you get your podcasts and leave us a review. We'll see you next time. Informational purposes only, and is not intended to suggest or recommend any transaction, investment, or investment strategy. It does not constitute investment research, nor does it purport to be comprehensive or intended to replace the exercise of an investor's own careful, independent review and judgment regarding any investment decision. This communication and the information herein does not constitute investment, legal, or tax advice, and is not a solicitation to buy or sell securities or any financial instrument, nor is it intended to constitute a binding contractual arrangement or commitment by State Street of any kind. The information provided does not take into account any particular investment objectives, strategies, investment horizon, or tax status. The views expressed herein are the views of State Street as of the date specified and are subject to change without notice based on market and other conditions. The information provided herein has been obtained from sources believed to be reliable at the time of publication. Nonetheless, we make no representations or assurances that the information is complete or accurate, and you should not place any reliance on said information. State Street hereby disclaims any warranty and all liability, whether arising in contract, tort, or otherwise, for any losses, liabilities, damages, expenses, or costs, either direct, indirect, consequential, special, or punitive, arising from or in connection with any use of this communication and/or the information herein. State Street or its affiliates may from time to time as principal or agent for its own account or for those of its clients have positions in and/or actively trade in financial instruments or other products identical to or economically related to those discussed in this communication. State Street may have a commercial relationship with issuers of financial instruments or other products discussed in this communication. This communication may contain information deemed to be forward-looking statements. These statements are based on assumptions, analyses, and expectations of State Street in light of its experience and perception of historical trends, current conditions, expected future developments, and other factors it believes appropriate under the circumstances. All information is subject to change without notice. This communication or any portion hereof may not be redistributed without the prior written consent of State Street. Past performance is no guarantee of future results.